Tax efficient pay for directors in 2021-22. This video goes through what is the most tax efficient way to pay yourself as an owner director in 2021-22. Most owner directors have a low salary and hopefully a higher dividend, and in that way they pay less tax in essence. So I'm going to look at what are the most tax efficient ways to pay yourself in the coming tax year, whether the budget in March affected things and whether the budget affected the dynamics of that, and then actually set out the numbers that I would choose as a minimum. There are actually a few options, but I'll set out the actual options for the actual amounts that I'll be suggesting for myself and for my clients when we start our payrolls in the new tax year in April 2021. I do regular videos about tax and accounting issues, so if you'd like to be kept up to date, then please subscribe to the channel, and if you press the like button it really helps the channel. Any comments, I'll look at your comments, and if they need a reply, I'll certainly like to reply to them. I'm always interested to know what you think about the videos. So a salary level for owner directors. So let's first look at the basics. Why directors very often have a low salary and a high dividends. And basically it's because of national insurance. Once you pay yourself over £12,500 a year, most people pay national insurance for employers and employees' national insurance, which is 12% and 13.8%. So if you add those together, it's 25.8%, as well as income tax at 20%. So that adds up to 45.8%. So that's an awful lot of tax, and that is why people have a low salary, because there are very high levels of overall taxation that there is on salaries. Whereas if you receive dividends, that will have been taxed in the company, and corporation tax at the moment and in the new tax year is 19%, and then you pay dividend tax at 7.5% as a basic rate taxpayer. And if you add 19 and 7.5 together, they actually come to 25.1%, because the 7.5% is actually after paying the 19%, and if you multiply that through and add it all up, it comes to 25.1%, and 25.1% is much less than 45.8%, and that is the essence of why people have a low salary and high dividends. There is another benefit to having paying yourself as dividends, is that you receive the money onto your personal tax net of that 19%, which is the main tax you pay and paid by the company. And because you receive your money net of that tax, you can actually get more of it through before you pay high rate tax. So you can get the best part of an extra £10,000 of income through without paying high rate tax. And that is a significant advantage for a lot of directors. And it means that for most people, for each individual, if your only source of income is the company, you can get basically £4,000 a month out. As a couple, £8,000, which here in the north of England is enough. If you want to buy a house in London, maybe not, but here in the north of England, £8,000 a month is fine for most people. The next question I want to look at is whether the recent budget affected the high dividend, low salary strategy. So has it been affected by the recent budget? And the simple answer is no. So first of all, the increase in the corporation tax doesn't take effect for 2 years. So certainly in 2021, 2022, it has no effect. But also even then, because the difference between 25.1% and 45.8% is so huge, if that figure goes to 30 point something percent, which is what the higher corporation tax in the future might mean 30% is still a lot lower than 45.8%. And I suspect that that is why the Chancellor chose to pick corporation tax as an increase. It's because we as directors pay a lot less tax than employees, and we will continue to do so, but it will be that the gap will have been narrowed. So the moment that you've all been waiting for, so what is the correct way of paying yourself as a director? Well, there's 4 possibilities. So the first one is, and this is actually what I will use, is that £12,500. After £12,500 of salary, then you start paying employers, employees and income tax. That's the 45.8% I was talking about. So I wouldn't pay yourself more than £12,500 a year unless you have good reasons so to do. The reasons might be minority shareholders, you haven't got reserves in the company. There are reasons why you might want to do it, but in a normal profitable company, and it's what I will be doing, is paying myself £12,500 a year. What that means is that I get about £1,000 a month, and £1,000 a month makes sense to me in terms of my personal finances, because £1,000 a month coming into my personal bank account, I can just get my head around and understand at a personal level. But there are other advantages of having £12,500. If you have interest income, so that you can get interest either because you have a lot of money at the bank or if you've lent money to your company, then the first 5,000 of that might not be taxed at all. So it's a tax deduction in your company and then not taxing your personal income tax, but only happens if you have a relatively low salary, like £12,500. So that's one of the advantages. Another advantage is that I just think that, you know, when you fill out a form, you can say you earn £12,500 a year rather than a smaller amount. I think that just helps. There are also just the way that there are a few things just niggles within the system. So yeah, there's this unearned income that I've just alluded to that might help you save some tax. There's also, if you just got 2 employees and you can get the first part of your employer's national insurance not paid, then you do actually get quite a bit lower tax on amounts just under 12,500. So you need a salary of some sort, because if you don't have a salary, you don't get your tax-free pay, because companies don't get tax-free pay, individuals get tax-free pay. So the first 12,500, some of it is national insuranceable, but none of it is subject to income tax if it's your only job, whereas you don't get that allowance in a company. So if you let that all be, didn't pay yourself a salary, your profits in the company are higher, that would be taxed at corporation tax at 19%. So you need to pay a salary to get your tax-free pay. The other thing is that you need to earn money in order to get your stamp paid, your national insurance paid. So unless you've done 35 years with your national insurance, having 35 years of national insurance history, then you won't get a full pension when you get to whatever the pensionable age is, or when you retire, 67, 68, whatever it is. So you need to clock in the years. And in order to get the year for your pension, you need to pay yourself £6,240 a year. So unless you pay yourself at that rate, then the year won't count towards your pension. So that's the next limit. So you've got the 12.5. Now there is also another number that's important, which is £6,240. You must pay yourself over that unless you've already done your 35 years to get your full state pension. And your full state pension is important because it's a lot of money. Even if you're hoping to have £100,000 of income in retirement, then £7.5, whatever it is, £1,000 a year is still a lot of money. you're probably spending on different things if you've got £100,000 of other income than you would if it's your main source of income, but it's still important, and it might be a holiday rather than potatoes. But so 6,240, that's the next limit. You must be above that. Between 6,240 and 8,840, you pay national insurance, but you pay it at 0%. So therefore you don't pay any, and 0% taxes are taxes that I can get my head around and like. So if you're going to go over the lower earnings threshold of 6,240, you may as well pay yourself 8,840, because at that level you're not actually paying any tax on your salary. And I know that some people just can't be bothered with paying PAYE, and so they pay themselves at that rate. After 8,840, then you start paying employers' national insurance, but not employees' national insurance. So you're only paying 13.8%. So very often that is a lower rate than anywhere else you'll pay. So you would, for almost everybody, you don't want to pay yourself at 8,840. You want to pay yourself more than that, because the next limit is 9,568. So 9,568, and at that point you start paying the employers and employees national insurance. So you may as well pay yourself up to that limit, because below that you're paying very low rates of tax. After that, then you are paying employers and employees national insurance, and I can see the argument why you might want to be at the 9,568 rather than 12,500, because the difference in tax is tiny. But for me, 12,500 just makes sense, because £1,000 a month makes sense. But equally, if you just don't want to pay a whole load of very little national insurance at all, then you might want to pay yourself at the 9,568 a year. And those are the rates at which you should pay yourself. Does the budget affect next year? Not at all. In 2 years' time, when the budget in 2 years' time, when the budget is fully implemented and the tax raises have happened, will you want to change your low salary, high dividend? I don't think so. But in the meantime, there are 4 different salary rates that you may choose. I personally prefer to pay myself at £12,500 a year, because the taxes are low. There's small advantages in the system of paying yourself at the 12,500 on other, because of its effect on other income, but overridingly because if, for a husband and wife team, if you both get a salary of 12,500, that's £1,000 a month going to your personal bank account, and that just is an amount that is easy to reckon in your head. And it makes sense at a personal level, and that's why it would be my preference. Thank you for watching. I will continue to give update videos on tax and accounting issues, so if you'd like to subscribe, you will be very welcome. Please press the like button, because it just helps get my videos across to more people, and I think they're important. And if you have a comment, I'll be interested to hear it and see it, and I will reply in time to all questions that need a reply or asking a question. Thank you for watching.